I'm skipped Appendix 3A, but I decided to cover Appendix 3B because I don't think you could teach financial statement analysis without covering these topics. And I'm a little surprised that they're in an appendix. They're in an appendix because we're not going to use them very much, but they're still really important. So you want to understand these and be familiar with these. I think pretty much anyone in accounting or finance should be intimately familiar with these ratios. So I don't know why they're in an appendix. Anyway, let's talk about them. We have the idea of liquidity, and liquidity is how much cash the company has, if the company has enough cash. And basically, if a company doesn't have enough cash, that's a huge problem because then they can't pay their bills. And you could have companies that are fairly profitable, but if they don't have enough cash, then they can't function. So liquidity is absolutely critical. It's like water is for people, that if the person doesn't drink water, they could die. If a company doesn't have a liquidity, then it could die. So two common ratios in liquidity are what's called the current ratio and the quick ratio. Current ratio is current assets divided by current liabilities. Anybody in accounting finance should know what the current ratio is. And the current ratio should be high. It's got to be more than 1. Now, sometimes I've seen a few companies that are less than 1, and they have good reasons for it. But if a company is under 1, if their current ratio is below 1, that indicates that there's a real problem. A high current ratio might indicate that the company is not using their assets very efficiently. They have excessive current assets, and that may also be a problem. The quick ratio is kind of a more intensive current ratio, and it excludes most of the current assets except for cash, marketable securities, and accounts receivable. So it excludes inventory, current deferred taxes, things like that. And this is really a tougher ratio. I think it's a better one because these are the assets that are really convertible into cash. Inventory is a little hard to convert into cash. Sometimes non-current assets are difficult to convert into cash. So I think quick ratio might be a little bit better if you really want to understand a company's liquidity. There's also the idea of solvency, and solvency is related to leverage. Solvency is, can the company pay its debts? And what we mean by that is long-term debts. Liquidity really focuses on current liabilities, while solvency focuses on long-term or non-current liabilities. And again, a company has to be able to pay its debts. If it's insolvent, that means it can't pay its long-term debt, and that's a critical problem. And you want to be able to look at solvency because even if a company is functioning okay now, they may have debt that's coming due, and if they can't pay that debt a year or 2 or 3 from now, then that's going to be a problem. So two approaches to analyzing solvency. One would be balance sheet based, and the other is income statement based, and we'll go over both. One ratio for doing this is liabilities to equity. Just divide liabilities by total stockholders' equity. Another approach is debt equity ratio, would just be long-term debt divided by equity. I happen to like, and it's not in here, is liabilities divided by assets. To me, that seems like a more usable ratio and easier to understand. The problem with liabilities to equity is that as liabilities goes up, equity goes down. So it's not really what we would call linear. So I think liabilities to assets is a preferable ratio. It just as accurate as this one. Long-term debt divided by equity again is another one. I'm not so crazy about that. Here you can see liability to equity ratios, and general one would mean that your liabilities are equal to your equity. You can see that restaurants, agricultural implements, cultural printing, home improvements have a lot of debt. Newspapers, clothing and accessories, and trucking don't have very much debt. The times interest earned ratio is an income statement based ratio, and it'd be EBIT, earnings before interest and taxes, divided by interest expense. And you would do total interest expense, don't net interest revenue against the expense, because total interest expense measures how much interest you owe. If the interest expense isn't reported on the face of the income statement, then it should be reported at the bottom of the cash flow statement, or sometimes it's reported in the notes. Another tool is what we call vertical analysis or common size financial statements, and also horizontal analysis. So vertical analysis, basically what you would do is you would compute everything in the balance sheet as a percentage of assets. So assets would be 100%, and you divide everything by total assets. And here you can see a vertical analysis for 3 years for Intel. And here you can see a vertical analysis. They say vertical and horizontal. It's not really vertical and horizontal. It's just vertical. Vertical analysis of Intel, where for the income statement, you would divide everything by total revenue. Now, what makes this useful is this makes the different years more comparable. So by comparing, say, cash and cash equivalent, you can see that cash in 2013 was only 6% of total assets, whereas in 2015 it was 14.8% of total assets. Things like that. You can see that, for example, liabilities as a percentage of assets went up from 36.9% to 40.7%. This is especially useful for the income statement because you can compare income statements side by side as a percentage of total sales. And you can see here, for example, that net income as a percentage of sales has increased from 18.25% to 20.63%. Similar, the gross margin increased, which is, it might not seem like a lot, but it really is, from 49.80% to 62.65% of total sales. So all of these different ratios that I've just gone over, while they're not critical for what we're going to do in the coming chapters, they're really critical for every finance and accounting professional to know. So you really want to understand how to do vertical and horizontal analysis. Really, this here is vertical analysis. Horizontal analysis is where you compare different years. And you also want to understand the idea of liquidity and solvency.